And thank you for joining. I hope all our friends who are online can hear me.
Yes. Yes. Hi.
Hi, Jay. So several board members have joined online, and this is one of our best attended hybrid sessions in recent times. So I just thought it'll be great for all of us to have this conversation. We've been talking about from our last gathering in December about the interesting dynamics between unicorns and legacy companies. And I think the CFOs are at the core of conversations around valuation, growth, and profit. So with that background, we were very keen to take this forward and create a larger discussion. And this will culminate actually in a series of outcomes in terms of papers that we want to move into, which will help all of you in your roles to interpret the changes which are happening at a very fast pace. And therefore, it will be a very interactive session as we always do at the CFO board. But what we'll be keen to do is we'll start off by a short presentation by Karan and Venkatesh, and Abhay will share their experiences and views on what's going on. And after that, we'd like to have as many thoughts and views from everybody as possible. So with that, Karan, may I request you to start?
Sure. Thanks. Morning, everyone. And it's a pleasure to be here. The topic that we're discussing, I think, occupies front pages every day. I think on the pink papers and the not pink papers too. Various adjectives are used. It's called the funding winter. Some say it's autumn. I don't know what season it is. Again, especially since I've been traveling. But I think what we wanted to do today was just get a conversation going on what really are CFOs who are helming the finance functions that these companies dealing with, and what have been some of their experiences, what are some of their challenges, and really what are some of their learnings that all of us can imbibe. Sakshi, we can just move forward. I thought we'd start with really looking at what's happening in the public markets, and I think again none of this is a surprise, but there has been a very significant slowdown in terms of the amount of capital that is getting raised in public markets. Again, we're not here to dissect why that's happening or to diagnose why that's happening, but I thought it's a good frame of facts to keep in mind as we progress in the conversation. It's not just the amount of capital; it's the number of companies that are coming to market that have also obviously significantly gone down. It's not an India phenomena alone; it's a global phenomena. I think US, in fact, the slowdown is far larger or substantial, again, given the size of that market and the depth of that market. So clearly, there is something that's going on. Sakshi, we can go to the next one. Again, I looked at the market cap of some new age stocks, and the idea is not to call out any companies here. It's just to look at how the market's behaving. And clearly, there has been a significant change in the negative direction as far as public valuations go. And I think that's also happening in the private markets. I think anecdotally or based on research and data that's available, it's clear that even private valuations are seeing a steep fall. Investors are concerned. You see some of the write downs that the large investors are taking. So there is clearly a level of concern. There are a bunch of companies waiting in the pipeline, and this is the India context for the markets to correct and for them to be able to come to market. So there is a very healthy pipeline. I think that's something that I do want to sort of reiterate, that there is a very healthy pipeline of companies that are waiting to come to the public markets. Let's go to next one, Sakshi. Again, looking at just the comparative performance of what I'm calling the new age tech firms, and these are the unicorns versus traditional firms. And if you look at this is the FY22 analysis in terms of how many IPOs happened in India, split between non-unicorns versus unicorns. And again, if you see the change in the market price or the gains that investors have made, the facts do say something in terms of whether it's, of course, I think the listing gains, even pop is a different story versus where we are today in terms of the current gains. And again, this is a summation of everyone. So it's not to say that there aren't companies that are doing differently from this lot. Actually, let's move on. Again, globally we've seen similar trends. I think called out a couple of companies here whose IPOs are very closely tracked. Actually, all of you know these names. But again, what's striking is the level of market cap that's been lost. And again, like I said, we're not here to diagnose why lost market. But today to discuss really how, as a CFO, you are dealing with, or some of you are dealing with this, and how that changed, let's say, from the last few. So next one. Again, winters here. Game of Thrones fans, I think, are well familiar with this term, but it's really, I think, and again, I think to me it's relative, right? I mean, I think there's still money available for the right companies and for the business models. It may not be that easily available, but yes, there is significant stress in terms of large deals and large capital raises, some of which have, of course, been delayed. Again, large private equity venture capital funds have gone out and sort of called this out that there is hiatus in terms of putting in fresh money in emerging markets too. And I think some of the larger ones have called out India, where they're saying we're not going to put in money over the next months until things change. So again, this is the context. What do you really do with this? How do you deal with this? And then we'll progress the conversation as we go forward. Sakshi, next one, please. Again, just data, number of deals and the amount of capital raised. What's interesting for me is if you see the India story, I think there is still, like I said, capital available. It's the question is where is it going and who's raising it and what are they doing to be able to raise that capital, right? And I think there is a lot of learning from that in terms of the basic tenets of how companies are valued and how capital chases companies. Let's go to the next one. Again, we've seen these public letters, from investors to their portfolios. They may not be public; some have become public now. Where I'll come to the two gentlemen sitting next to me to get their views too. But really asking for a relook at how business is run and how, or what should really be the imperative. What should be the company's imperative? What should be the business's imperative? As a consequence, what should be the CFO's imperative in terms of the path forward? Next one, please, Sakshi. Again, profit seems to be resonating more often. And again, my personal view is nothing's changed in terms of the centricity of profit. So I don't think it's profit versus growth. Just to put it on a table, I think it's profit and growth, and that's always been the case. I think one or the other gets amplified depending on the season, so to say. We're talking about funding winters here, but it's really about as a responsible corporate, what are we doing to sustain and create value that we want to focus on. Sakshi, please go next. So again, I think I sat back and thought about what really, and again, this is nothing's new here, right? I think these are all basic tenets of a valuation or value in that sense. So whether it's corporate governance, I think, and I think the important point here is one, how does this help you create value and sustain value, and more importantly, also the fact that if you miss any of these, how do you lose value? I think publicly there are enough examples where companies have lost significant value. Let's say if they slipped on one or the other of these. My personal favorite here is the non-financial aspect of value creation, and I think that's more relevant or very relevant in the the growth stage for a lot of unicorns. And I can't emphasize it enough that the value that these companies are creating is immense, right? They've changed the way we consume, they've changed the way we commute, they've changed the way we sort of read, eat, pretty much our fundamental behaviors. And how do you put a value to that, right? Today it's not measured. Today you measure metrics, you measure sort of unit economics, you measure various KPIs that say, okay, you're on a growth path, you're on a profitability path. But how do you measure all of the other sort of value that you're creating? the jobs that you created, the environment sort of that you sort of protected by, let's say, switching to more sensible business practices, the talent that you sort of nurturing and creating across the breadth of the country. And I remember having a conversation with one of the railway board members a couple of years ago. She said, look, how do I solve this, right? I mean, we make money. We are we're the largest employer in the world, but we don't, generate what's the bottom line, right? The black number at the end of the day. And their struggle is really the same thing, right? That you go and service non-profitable routes, let's say, just as an example, because there's a national service obligation attached to that. Now, as a finance, he was a finance sort of member on the board. So her view of the world was, how do I sort of articulate this value, and how do I bring it to investors? How do I bring it to the government to say, okay, don't just push me on the operating margin, but also look at the non-financial value I create. So I don't want to overemphasize that, but I think that's something I would love to come back to, through the session on, how do we all get our arms around, and what are some of you doing, or what are some of your lessons, learnings in terms of being better at articulating the non-financial value. Again, the others on the slide, I think I don't want to go into each of these, but I think there are, and I'll be happy to share them. There are enough examples on what's worked for companies and what's not worked. On the positive and the negative side, and how that's taken away value or added value to companies. So let's move to the last one for me. So again, when I sat, and I was writing this last night, I said, look, if I were a CFO, and what would I be thinking about? And it was nothing on the slide. Okay, it was about, how do I deal with volatility, and how do I mean, the basic human tenets, right? That how do I get inside the founder's head and understand what is really, bothering him right now, right? Because of the market dynamics, because of the noise in the market, because of everything else that's going on the outside world. So they were fairly basic sort of behavioral attributes that I thought I'll put down. But then, being a conservative consultant, I said, look, let me sort of also put down some other things. So I said, look, the goalposts, right? And the goalposts keep changing. What's my objective? What's my goal today? And that's absolutely right. I mean, that's the way business should be run. You can't have static goals. But how do you, recalibrate? How do you keep recalibrating the goals? And how do you ensure there's, harmony between what you're thinking and what's inside, let's say, the founder's head? And then we'll talk about regulators, we'll talk about other sort of, stakeholders. But how do you ensure that harmony and symphony, and then maybe there is symphony at times, maybe there isn't. So how do you deal with that? Data and insights, I think, again, a lot is said about this all the time. But to me, it's really about what are the metrics you care about. How do you, ensure that data is available? How do you use that data to enable decision making? And then I think we've seen enough examples of how the quality of the data really impacts how a business performs. Setting and reinforcing, and I was going to call this the plumbing, but then I said, let me be a little more diplomatic. Reinforcing the foundational processes. And I think it's a good time now, given the focus, even some of your investors are asking for, to really look at the foundational processes and make sure that you're comfortable with them. Stakeholder expectation management, again, we'll touch upon this as we go forward. How do you sort of balance the contrasting, and again, this is all in the context of what's happening with the growth imperatives for unicorns in today's market. So let's just keep that inside. Governance and decision autonomy, again, I deliberately kept that, and I wanted to be a little provocative here in terms of the the freedom and the flexibility that you have as a CFO to be really able to implement what you want from a, let's say, leading practice, or even the ability to take sound financial decisions. And how does that again intersect with the growth objective, or the objective to have a bottom line, or again, what's going on inside the founder's head. And the last one is really the how do you again, I remember a client conversation a couple of years ago on the horizon of the planning forecast, and obviously all of us know that's shrunk, right? But I don't think there's a horizon today, right? It keeps changing, and it should change. It's dynamic. It also depends on who's looking at, or wants that information, or who wants to analyze that information, and what's the end goal. So again, these are some of the thoughts I had, but let me hand it over to you, Abhay, to really get your sense on some of these. And I know you kind of done a great job at sort of even things like setting up the KPIs and the whole focus on the non-financial aspects of what you guys do. So
yes. Before Abhay, I think Karan, you've been very diplomatic, and let me not be so diplomatic. I think the fact which has really been the trigger for this conversation is that the financial discipline, which was always there for legacy companies, is now finally coming down on unicorns and the companies who are new age companies where funds were never a problem, everything else was. So growth was important, profits were not. And therefore, we are seeing the maturing on some ways on of the ecosystem, which is forcing maturity on unicorns. So I think it boils down to this, and therefore, how are the companies reacting? Okay. And before that, it was remiss of me to thank Abhay for hosting this in person, and also for arranging the Zoom and everything. But we're looking forward to a great lunch too.
Firstly, thank you for everyone who's attending in person and everyone on the call. My pleasure to host. Quick introduction. I've been at Urban Company for about 2.5 years. I joined actually 8 days before COVID. And by the time I found the right route to office had shut down. So it's been quite a journey. But let me share a few thoughts of how I see it as someone who has worked in a large established organization for the better part of his career and what I see now. I think for a startup, growth continues to be paramount, right? There is no rethink there, right? If you're not growing, you don't have product market fit. It's quite clear, right? And startups are based on the premise of very large addressable markets. And if you're not growing fast enough, the addressable market is going to someone else, right? So if you're not growing fast enough, you're not a startup, you're a small company. Right? So I don't think there's a change in that thinking today either. Right? I think the question, as Pranjal correctly is, at what cost? At what cost do you grow the right way? Till now, I think in many cases, the conversation was that let's grow and profitability will come with scale, right? That realization has now dawned that it will not come with scale. That slowly seeping into the ecosystem, into folks who run the business, and that's changing. Need of the hour is to show a reasonable path to profitability. Right? Many of us have the fortune of having good balance sheets, raise money before the downturn, but still have a clear path to profitability with reasonable assumption. Assuming everything will go right is no longer accepted. The market performance of many companies see a clear differentiation between people on mute. I think people on mute if possible. Okay. So I think there's a clear differentiation between companies who are profitable or are almost there versus companies who are not, right? And that's reflected in the market performance as well. One big realization we also have, especially for late stage, as you grow larger. Sorry, I'll use. Yeah. So I think the thing is that as you larger the only at the burden of proof that you can be profitable, that you can make money, that just increases, and anyone losing cash right now is running on a clock, right? From all stakeholders, from all investors, right? So that's there's just some background of how the environment has changed. I think the second piece I want to address is what is profitability, right? Many of us have grown up and sort of learned that profitability is PAT, right? For us, profitability is profit after tax, clear definition. For, I would say, companies starting up and companies who spend some time, the first objective is actually cash generation, right? Are you generating cash? Are you generating even 1 rupee of cash to show that the model is sustainable? And that's where I would say much of the ecosystem is striving towards. The one big element, between cash and PAT, I would say, many companies have depreciation. Most startups tend to be asset light. Is ESOPs, right? And ESOPs are a very, very important part of the compensation strategy for most startups. It helps them conserve cash while helping employees participate in value creation. and they're becoming an increasingly larger component of the P&L. I mean, many of our P&Ls have ESOP as the largest line. I think the thinking is that first we want to generate cash, and then we'll generate enough to cover the ESOP costs. Well, there's no doubt that ESOPs are a real cost. They dilute existing shareholders, but to start with, everyone wants to make cash. The second cut, which is really difficult to demonstrate with credibility, is that I'm making money in one part of my business, right? Startups are in constant investment mode. I'll give you our example. Besides India, we operate in 5 overseas markets, right? What we're trying to do is, how do you get to profitability in India as soon as possible while continuing to invest overseas? Even if that narrative is clear, I think that is a good job done. Right? So demonstrating that, and the people are different cuts. Someone can talk about one segment, someone can talk about cities. We've all seen disclosures in companies listed recently on how they're demonstrating a clear proof of concept. Let me put it that way. Right? So having a clean narrative, making it clear on what your strategy is, where you will make money, where you will invest, is very helpful. The third part I wanted to cover are, what are the guardrails which teams should look out for? Number one actually is unit economics, right? If you're contribution margin positive, I think you're on a good wicket. If you're not contribution margin positive, you lose money on every transaction. It's a tough place to be in. It's a very tough place to be in, because with positive contribution margin, operational leverage will kick in, and that's where the growth angle comes in. Right? So, getting there is very important. And however, if you're in a hyper-competitive environment and you have strong competition, it's not easy, right? I'm not for 1 minute trying to downplay the difficulty of being positive economics when you're a strong contender, but that's the need of the hour, and hopefully sense will prevail on both sides. And the second one is more fundamental, and this I faced as I came in. The realization of which costs are fixed and which costs are variable is poor, right? If you have to keep creating infrastructure to grow, your costs are variable, right? I mean, traditionally rents are fixed, salaries are fixed. They're not. And first understanding that yourself, and then building that understanding within the org is a very important thing to do, right? Otherwise, we'll keep assuming that scale will solve the problem. It will not. And that's something many of us grapple with regularly. And I think the third one is operational leverage. Very good to be clear on what scale results in profitability, and how do you get there. What's the role of the CFO? I think first is understanding your P&L really well, right? Really, really well. Knowing which costs are fixed, as I mentioned, which are variable, unit economics, etc., very important. Second, always allocate resources for growth, right? Investors are allocating money to you for growing the right way, right? But if you're not growing, that's it. So in growth versus profitability, at least in my mind, growth always trumps growing the right way, I would say. The third is, Karan alluded to some of this, is having a crystal clear narrative, right? Being clear with people, with investors, with stakeholders, with employees. Think, where are we heading? Which parts of the business need to break even soon? Which parts will we continue investing in? What are the various, I would say, milestones you need to meet? Very, very important. I think the fourth is cost efficiency. I think as CFOs, we tend to excel in driving cost efficiency. But if your model itself is skewed, cost efficiency doesn't help, right? And I realized that over a period of time that you need to go and change the core operating model, the way the on-ground activity happens for the business to turn profitable. I think last, I'd say, phrase which is often used is burn versus investment, right? At what stage is spending money burn, and at what stage is investment? Very nuanced point. But it's your job to understand that and call it out when it's going the wrong way. So with that, I'll just hand over to Venkatesh to share his thoughts.
Thanks, Abhay. So I had finance and supply chain at DealShare. None of you in this group would be the TG for DealShare. So let me give a quick introduction. So DealShare, we are an online grocery retailer. Our TG typically is families with annual income of 6 to 8 lakhs and below. Obviously, the density of these families is higher in tier 2, tier 3 cities. We would consider ourselves to be, say, a DMart minus. So we are different from our TG is different from what Blinkit, Instamart, Zepto, or a Big Basket, etc. would be. Our largest market is actually Rajasthan. We started from there. So that's the background. I'll not get too much into it. I'll just cover a few points or elaborate slightly more on the points which Karan and Abhay touched upon. Starting with, say, stakeholder management, especially for startups. See, what has happened is time has got crunched. So we talked about legacy companies. What would happen in a legacy company in, say, 15 to 20 years? Now the expectation is to do it in 3 to 5 years, and that has one set of consequences. I mean, it has a consequence in our own real life. Earlier, we used to do shopping once in a month. Then it turned out to twice in a week. Now we need it in 10 minutes, So things have changed. Let's be clear about it. In the startup ecosystem, the funding environment helps compress and get into fruition a lot of great ideas. I think we become too negative in general. We talk about Paytm losing so much, we talk about others losing so much, etc. But we have to realize, I mean, give credit where it is due. They changed the world. They digitized. You see anybody coming from North America, West, etc. They find it mind blowing. So they changed that. I used to live in Gurgaon earlier also not apart from this. It used to be a nightmare traveling in Gurgaon before Ola Uber. It was crazy. You had to book those 4 hours, 40 kilometers and 8 hours, 80 kilometers, the taxis, etc. So there are multiple examples you can go, but I don't remember when I went last to a grocery store. So all these things happen. These guys have also changed the world. Now, what happens is when you crunch the timelines, obviously the expectations are higher. And unfortunately, I mean, we are all human beings. I mean, human beings are social, etc. We are different in that sense. So the expectations also grow accordingly. So it is the highs and lows are bound to be at a different level compared to traditional companies. So that is something which is there. But one thing which all startups have to do is in this discussion of growth versus profitability, growth and profitability, etc. Stakeholder management is very critical, especially as CFOs. It becomes important. Very quick context without going too deep into this. So my last 3 organizations have been private equity funded. The first one, already profitable, went for work towards an IPO, did an IPO. The second one, startup, 8-year-old, but profitable, EBITDA positive and even PAT positive in couple of years. The DRHP, we talked about governance, was so strong, we turned around the DRHP from the kickoff bankers unit to DRHP readiness in 2 months, because the governance systems and readiness was extremely, he is aware of this, is extremely strong. So we turned it on. We didn't go IPO because of the conditions, etc. And I've just recently joined Dealshare 4 months back, 3-year-old company, large TAM. Profitability is something which we really have to work on. We are working hard at it. It's a major problem in grocery to figure out what it is, but hyper growth, so there are different things. In all these things, what happens is as long as the direction is aligned between the organization and the investors, it always helps. The probability of success is there. It is a reality that growth is the need of the hour. Without growth, frankly, people will not come into India. Let us not looking at it. Incidentally, I also see a positive with all this talk about winter coming in. India is in a unique position. Remember that China is not going to get so much funds in the next year and a half. There is a lot of money sloshing around. Fed can raise rates as much as needed. There is still plenty of money sloshing around. Good concepts, good ideas will make its way into India. But all this, so stakeholder management critical. There will always be different views. Remember, also the investors have fund lives. When they take long term is 3 years. 3 years is extremely long for them. So we have to remember that. And this is a reality. I mean, you don't see the color of the money when you get it in. So obviously, when they ask to take out the money, these expectations will be there. So we have to balance all this. Important is for the founders and the CFO, especially to be aligned with the investors on the path. And this is not always the case. So this is one critical role where the CFO has to. Second is the governance part. Unfortunately, we've had instances in the last few years where there are issues right from the top, and that creates a negative impression across. It also, as far as the organization is concerned, leads to too much of leakages and brings in inefficiencies, etc. So this structure is very critical. Now, this growth coupled with the governance and compliance is something which the CFOs have to look at. I mean, that's how. I mean, we should not be joining startups. Experienced CFO should not be joining startups if you're not up for the challenge. And it is a challenge because the growth matters quite a lot. So we started in Jaipur. It was easier. The whole team is sitting in one warehouse. It's easier. We expand to Rajasthan. It is still easier. We are now in 8 states. It becomes difficult. How do you manage the processes? In retail, there's always pilferage is an issue, for example. But how do you make sure you manage it with the growth? So this governance and compliance part is something extremely critical. The earlier one starts, the better it is. And also what happens, it is the base effect. I have had with some of the CFO community discussing somebody going towards an IPO, suddenly decides you need an ERP, you need to all the compliances, and that year profitability is impacted. Now, if you had had it already from the beginning, the delta would not have been so much of an issue, etc. So governance and compliance is to be extremely critical when we're looking at this discussion between growth and profitability, or it's not a between, it's and. And the third one, which I think is very important, is the team. While we talked about the compensation, ESOPs, etc., it requires a different mindset. I remember something which the founder of in the last December one for Policy Bazaar was mentioning to us. See, in startups, the highs are very high, but the lows are very low. You know, managing a high is very easy, but managing the low is difficult. So it's critical in this journey that the team's state of mind is tuned to working in startups. This is extremely critical, you know, and this adaptation, without this adaptation, again, what I would say, the organization may not necessarily move on the right path. There will be phases where the investors will change their mindset. They will move from growth to profitability. They may also go back, because remember, it's also a collection of investors. They also within themselves have different views, etc. So, you know, these things, so the mindset has to be there that you are working in such an environment. Learn to accept the lows also, it will come in. Again, I believe in 6 to 8 months, when the cycle turns around, there will be a lot of funds floating around. So basically the idea is there. Summarize, I think there are 3 or 4 stages of a startup. I'm making a general statement, might be not be true for all startups, but the first 2 to 3 years, again, depends on the industry, etc., have to be stage of hyper growth, because you have to see whether your product market fit is there. Without that, everything else is gone. You know, without that, you can't figure out. So that is, it has to be hyper growth. You need to be able to scale up. Then the next phase is you have a sight on unit economics. You have a reasonable sight on coupled with really high growth. You know, not the hyper growth, but high growth. The third phase where is where you are in within touching distance of profitability or already profitability, but continue to have steady to high growth. And the last one is, of course, what the really good companies have in terms of steady growth and steady profitability. Here, there is a lot of interesting metrics also around. One thing, I mean, we don't have that much of data as such, but one interesting metric which, for example, SaaS companies in the West look at is a rule of 40. So they say the growth plus EBITDA percentage should be equal to 40. Now you can say whether it's 40, 50, 60, etc. So obviously earlier you might have 100% growth and minus 60 EBITDA also, you know, so it would move. So, and this pendulum has to move from the higher growth percentage to a reasonable EBITDA percentage. So these are the 3 things which I thought I would like to add on. And Pranjal, point to any questions or have a discussion.
Great. So I think we'd like to listen to this.
Just I know I come from a different industry, which are real asset industries. So from a startup point of view, which is based on technology, ultimately it's a business. You know, as a business, it has to.
So can you also introduce yourself? Everybody gets to know, and also people who are online will get to know you. Thanks.
Okay, my name is Siddharth. I have. I'm right now, not full-time employed. I'm more on my own, but I have worked almost 35 years with companies like Transocean, Petronet, GMR Airports, Adani's. So it's been on the entire real asset side. And so looking at it from a outside inside perspective, I am listening to the conversation we are having now, and plus the conversation we had last time we met. There were 1 or 2 thoughts which I maybe I had. It's more some question which I have. ultimately, valuation which is reflected of a startup has to be commensurate with the profitability and the trajectory of that profitability. And that's true for any business. I mean, it's not just true for a startup, it's true for any business. I think what has happened over the last 4 or 5 years when the startups have surfaced and we have been seeing the growth of unicorns is that investors have been cheerleaders. They have, there was enough money sloshing around, and there was a, I would say, competition to invest in startups, and this was basically a valuation game. You have maybe a DCF of 12 years, 15 years to show, and based on that, there is a valuation based on which an investor would invest. And it is definitely the high valuation is based on a very high growth, and high growth leading to a high profitability at some point of time. Now that's for a investor in a private investor who is investing. He ultimately wants an exit. He's not there for the entire life cycle of the business. He wants an exit, and from an exit point of view, they want an exit at a valuation which is higher than what they have invested. They want to make money. And one of the ways to exit, fortunately and unfortunately, over the last 1 year or 1.5 years, has been the public markets. There is a very key difference between public markets and private markets. In a private market, you can sit around the table like this and debate that this is my trajectory, this is my trajectory to profitability, and this is how my growth will pan out. In public markets, where your quarterly results are being viewed every quarter, and I think many of the promoters and they are actually fumbling answer questions of public investors. I think there leads a issue of credibility, because the investors have long gone. They have sold off. Some of them are still there, but I think they have recouped their investment and long gone. And I think it is the promoters or the startup guys who have come in at the start who are really now facing the brunt of the public markets. So I think this disconnect needs to be addressed, and I think that is what is being done as part of this entire churning in the market. That public investors have realized that, look, I mean, I have invested based on a story which the investors have sold me in the IPO, in the prospectus, that this is the valuation I have invested in, and naturally I'm giving it to you at maybe 2x my valuation, and you will also make money. I have made money, you will make money. But unfortunately, that's not reflected in the the last 4 quarters. It may get reflected in the next 5 years or so. But public investors don't have that patience. I think that is what may be the critical issue at this point of time, and I think that's what is leading to a rationalization of valuations. I mean, I'm open to any thoughts on that.
Anybody wants to respond to what's that? Sugata, sorry, can you also introduce us?
Yes.
For the benefit of everybody.
Yeah, sure. So I'm Sugata Sarkar. I'm CFO of Schneider Electric for a long time, and right now I advise companies, work with CFOs, etc. So that's enough.
To begin with.
No, because Siddharth picked up the point, I had a slight twist to the same point, so I thought kind of join with that. You talked about stakeholder management and governance, etc. And what we see, this is where he's also, I think, kind of alluding to, is startups which are now listed, right? Their investor communication in this closed room, let me say, is poor. Yeah. The basic things that we've always known about investor communication as to what you have to communicate to investors, how you have to communicate to investors, they are not being followed. Now, I mean, I don't know whether it's intention or it's capability or what. I mean, I hesitate to think that it's capability, because these are very capable people. I think the orientation to do the proper investor communication, especially when you're doing acquisitions, for instance, using now public money to do acquisitions, or working on chunks of the organizations and restructuring business, the kind of communication that you have to do with investors and justifying it as a part of the strategy, which we don't see in some of the large startups which have listed. And there's a lot of air on that, as we all know. So I think this is something where I suppose CFOs which are within the startup organizations have a kind of responsibility to align the organization before they go public. It must be difficult, but we see that. He was alluding to it in a different way. The other thing, you talked about a lot of matrices, and that makes a lot of sense to us. Now, for a long time, it seemed that investors are very patient for startups. So growth is important. Therefore, you go on pumping money and invest so that business grows. Now you're saying that growth is still important, but profitability to show visibility, right? Now, this is that working on where you show, let's say you're starting a new business or a new division, and you say that this is the visibility of the profitability or cash generation. And if it doesn't happen within that time, there are some repercussions of that, right? So here, what's going to happen? Because growth is still supremely important, as you said. So the investments have to come in. Sure. And then you've given a visibility of profitability and cash generation. Let us say that it's not on that path. Then what?
And that's a very interesting question, something we grapple with every day. I think the choices become far sharper. So if, let me take an example. If you had a plan to expand to a number of countries in the future, right? You will now say, listen, I'm going to concentrate my bet. I'm going to go to the largest market out there, and I'm going to give the general manager there a tight show, saying you have 3 years, grow the market, show me there's proof of concept or I shut. And I think what this is forced is it makes decision making and making choices far sharper, where the patience of, I would say, the management and investors is now lower, right? Questions get asked on new categories, new businesses, and that's natural evolution, right? I mean, as startup grow, for example, we recently inducted an independent board, right? We didn't have an independent board. We've got 4 independent board members. I can already see the tone of conversation changing, where earlier it generally tended to be a very encouraging conversation. An independent director are asking far sharper questions, saying, why does this choice make sense? Or what time frame are you looking for this investment to pay off? Else don't do it. So this evolution is already happening in my view.
Yeah.
I'll say. Okay. Yes. Sorry. Thanks for. My name is Yogendra Singh. I'm CFO for Hero Enterprise. So the question that you're talking about, and we're talking about stakeholder management and communication with stakeholders. What's happening is probably the transition from one set of stakeholders, investors, to a larger set of stakeholders, which is the general public. That's where this transition probably is time, and you have to make different communication while speaking this set of clients. There was one more, a very interesting, on one of these slides, it said, running school, I said, no winter for real business models. That's a very important comment. I would like to just really understand what is real business model versus what is unreal business model.
There was always a reference to real aspects.
I understand it, and especially coming from a traditional asset, real assets, business models. We all really see.
But your Hero Group now is in so many different sectors. I mean, your enterprise, you're investing in so many.
Yeah, we are. Even
technology is unreal. I mean,
no, that is also our own understanding of the role of technology and what it can actually generate and what cannot, and what what he said that what we were the kind of growth we're achieving in 10-15 years, now there is expectation to achieve it in 3 years, which is not only a fact but actually possible, and that is possible only because of the technology. We all understand that. So therefore, it does give us that opportunity. But the fourth question of whether it's a real business model or not, I mean, that remains. So it's like
just one point I would like to put forth is technology is an enabler. It should not be confused with being the only product. हम तो तेल आटा चावल बेचते हैं. So that's the basic. We need our warehouses, which are physical infrastructure. What they do is get a lot of human beings give real service, creating employment, etc. So The thing is, I think it's just that technology is an enabler for a lot of things which have not come into place. We evolved, right? I mean, it's also, it's not exactly the situation of the Luddites back in this thing, but this will evolve. So that will important point to address in terms of both of the, in terms of communication to stakeholders. See, the new age technology IPO story is a 2-year story in India. It's at its infancy. So we have to give some rope to that. We have to give some rope to that. This industry in the US is 30 years old. Just one day, I'm not comparing, and I don't want to say everybody will be as successful as it is. Amazon price in 2000 dropped from $100 to $6. It was treated the same way as what Paytm is treated, or even worse. Of course, there were pet.com was the biggest unicorn at point. It collapsed spectacularly. So these things will happen because still we find the monetization capability. Amazon was not making money for a long time. Google hit upon monetization much earlier in terms of their ads, etc. So these things will happen. But in the communication aspect, I think we are learning. He mentioned about them already having an independent board. Many of my peers who are in either who have done recently from the new tech or who are in the planning are already having this structure in place, and this can only improve the processes. It is not at the place where it can be. There have been a lot of situations. Everybody's learning. SEBI was also learning actually. When they did the Zomato IPO, they didn't know how to do it. Meant like this. All of us who had to prepare DRHP letter went to do a nightmare because of what they do not check. And then they say, and it's not neither Zomato's fault, neither SEBI's fault or the organization. So I think this will improve, and it needs to be. There's no doubt about it. And real, yes, as and when we move into the relevant areas, as and when we change those particular areas, some of those will also involve physical assets. Like we are starting, I mean, we need the physical assets to get our warehouses in. We are now even thinking of going back. So should we have our own last mile fleet itself? So, that would all these things will come about. So, but these are new ideas waiting out there. That's why I guess they are not the hard infrastructure type.
And I think I can validate some of this. I work with a number of private companies that will eventually go public, and I can see I've been doing this for all my career. So I'm a partner with KPMG. I've been doing this for 20 years now. But I can tell you, in the last 18 months, I've seen companies waking up and saying, "Look, we want to do this 3, 4, 5 years in advance of the IPO." Getting a board sorted, getting process, getting compliance right. That never happened. And that is very encouraging, at least to me on the other side, that my clients and prospective clients are now at least having this conversation with us much earlier on. And I think the second point is to your question on real businesses. I think the point I was making earlier, all of what they do, or I'm just pointing at them as what a unicorn universe is real, right? I mean, it's changed the way we consume. I think the struggle today is that we can't value a lot of that, which is what I was saying when I made my comments. Why did retail investors want to be a part of it? Because we touch these businesses every day. रोज Paytm करते हैं, हम रोज urban company से कुछ लेते हैं, हम रोज, so why we wanted to be a part of that growth journey, and that's why a number of retail investors, went into those stocks. Now, whether or not they understand the business or not, I mean, business versus consumption from that business is very different, right? We all know that. So this whole debate about private versus public, I think that's been going on for eons, right? I remember 5 years ago, there was this huge debate about companies even like Uber saying we don't want to go public, Square saying we don't want to go public, we'll remain private forever. I mean, if you Google it, find the stories.
When he said that we will convert.
Correct. But the fact is that ultimately, capital has to move around, right? You can only pass on, capital privately or, assets privately up to a certain point. Beyond a certain scale, you can't. So I think that debate, honestly, for me is, settled that, eventually the path is to, go public or to, merge into something that's larger. But yes, the rationalization between, the rationalization between stakeholders, the different stakeholders want, right? That needs to happen. And it's a journey, right? I mean, 2 years is hardly a time frame. It's a blip.
I think is it really a
no, that's what I said. I don't think
it's rationalization.
I think the right company getting money
is the where I think people have become more sensible at the investor stage. That look, I need to invest rationally, because at the end of the tunnel, the public markets is not going to support my valuation and how I look at it.
Rekha?
No, I.
Sorry,
I do questions.
introduce yourself also.
So, okay, Rekha, I'm the CFO of Microsoft. One question for you, because you made this comment in terms of, this pressure in terms of creating outcomes within 3 to 5 years, how do you balance that, the amount of pressure that's on to show the results and the outcomes, right? And also creating trust when the communication to the stakeholders, meeting their expectations, but at the same time, there's enough and more governance that is in there so that there's that trust that is created. That's point number one. And then the second one, I'm really curious to understand, when cash is super tight and it's the king, how do you make sure, we're learning fast, even if you fail in a lot of initiatives we take, you fail fast, but learn and then move on also, right? Because there's always that level of optimism that one may have. Okay, let's keep trying, maybe one more month, we'll see the returns, but at some point one needs to cut the cord also. So any lessons there, that'll be super helpful.
Yeah, I'll try and answer the second question first. And my answer, I would say, is a little relevant for the consumer industry, but many of us work there. For us, the true sign of product market fit is repeat, right? If you launched a service, are consumers coming back and trying you again? If they're not trying you again, it's not a good product, right? And that's what helps you rapidly cycle through services, saying, I've launched something, I've piloted it in 2 cities. And in the initial phase, there is burn, right? You set up infrastructure, you set up facilities, etc. You make sure there's enough liquidity on both sides of the marketplace. But if consumers don't come back, and it's very easy to spot, right? If consumers don't come back or your ratings are poor, that's it. It's quite clear. And then I think the job of the CFO is to call it a day, right? Because optimism always prevails. Saying, I'll tweak the model, I'll do something else. But if that key metric of, and we call them revenue cohorts, if the revenue cohorts are not improving, they're not smiling up, that's it. You don't have a business model. And it's fairly easy. I think that's generally accepted. It's generally
the point
accepted
at which
metric.
you have to shut it down.
Yes, because you're seeing that consumers are not coming back, and to acquire new consumers, I have to keep burning CAC and doing differentiated things, which
So
simply
is that the
sustainable.
call of the CFO to shut down a particular service or a product?
It's not the call of the CFO. It's the CFO's job is to show the mirror, right? Saying, we agreed on a certain time frame for this to succeed. We've iterated. We've tried 20 different things. It just doesn't work, right? And it's time to cut the cord.
And do you find more receptivity, I guess, today versus 6 months ago or
No,
12 months
certainly.
ago? I think you made the point earlier, right?
Yeah,
Sharper,
far sharper choices, right? You will not stretch beyond the point. Because,
so you're not the bad guy anymore to call it out.
yeah, it's not bad. It's just good sense, right?
Yeah,
I mean, good companies ran that way forever. It's just become far sharper.
Sometimes the repeat could always be there, but the volume is not good enough also, right?
Right. So,
Would any of our board members and guests who are online like to share a thought or an experience or a question?
Or maybe just to address also Rekha's first question. Before that, I think I'm glad to see that we are on the same page. I haven't discussed with him, but he's talking about repeat. That's actually, we are obsessed with repeat. And in our case, of course, there has to be multiple repeats because of the nature of it. The key, I would say, would be ruthless prioritization. And that is something which people are learning now. It doesn't matter you have 5 verticals, but within those 5 verticals, you need ruthless prioritization. In case we have one, when we are going, and what we have prioritized is basically cash flow. For example, starting from that, it goes down. Because if you don't do that and reprioritize, I mean, maybe the cycles are quicker in a startup. This review of your priorities are quicker, but without that, it is not possible to sustain. So that is the key to manage all this pressure and all the other related issues which come.
So, Kedar, I thought you wanted to ask a question. Please do it.
Thanks. So I'm from Renew Power. I just had one comment. See, I think when you deal, especially with the listing scenario, you may get into a situation where the demands or the interests of investors on the board and retail investors who are going to subscribe. If there is a conflict between these two set of shareholders, I think managing that will be very important. Because ignoring the needs of retail shareholders or public shareholders will bring in a lot of onerous liabilities, and since the board will be dominated by financial investors, I think there is a very fine walk that CFOs especially have to demonstrate there. So I don't know what is the experience in this case, because you make a lot of you file prospectus, you may not give projections in that. But a year back, I remember one company which got listed. They said we will not do a quarterly earnings call, and I'm sure the CFO of that company would have found it very tricky. So I think living through this dilemma, situations involving dilemma is going to be quite tricky, and you have to balance both, all the interests, to keep balancing, and you have to keep everybody honest that, look, you want this particular style of functioning, but hey, there are other stakeholders as well, So I just wanted to make that comment. And I don't know whether some of you have experienced this or not.
Yeah, so let me share also, because I took a company through the IPO also and did the listing. You're right, it gives a different challenge. But another good trend which I am seeing is that many of the larger startups have also got the CFOs having background of listed companies, strong processes, etc. That gives a very different perspective. I think you've been in Livers, you've been in other listed companies, you've been in multinationals, even if not listed, you know the type of framework which you need to work about. And I think that's also a good trend which is happening across, and that can only improve the overall organization. The rest of the team might be completely not exposed to these type of things. But the fact that the CFO is exposed, I think it's a great step, and I'm seeing that across.
Okay.
Would anybody else want to respond to what Kedar said?
I think just one thing, Amit Sachdeva, CFO, was the CFO of Blinkit. So I think we've been in the news for all the good, bad reasons. So I think two things. First, we are, I think as a general public, we are over eager to write obituaries, ours are written every day, So I think what we fail to appreciate is that I think they're comparing a very mature models over the last 50, 100 years with something which is as new as like 2-3 years back. I think our ability to not comprehend that, tends us to superimpose those preconceived notions onto these new companies as well. I think Kedar made the point of not giving quarterly financials or not giving quarterly estimates in terms of what we are going to be next quarter. I think we're looking at companies who do not have a very predictive model today. And I think a lot of it is because of a product market fit being assessed. A lot of it is retentions. You talked about conversions. And I think the how technology is actually changing is very different. The version of Uber 7 years, 5 years back is so different in terms of how they've evolved over the last 5 years. How quick commerce has evolved. I think we evolved within a period of 6 months from probably what Dealshare does to probably a 10-minute delivery. And I think all these models, we feel we will evolve to that kind of maybe governance, reporting requirements, and all of that. I think that is where there's some slack to be cut in terms of giving that rope for these companies to actually help evolve in the new system. Second point, I think it is not easy, especially when you're actually talking about cash flows, profitability, growth, all of this. And I think it is. I think it's going to be over in the next 6 to 12 months. I think capital is there, capital will be there. I think the only challenge is I think the same companies that are talking about Secura came up with a black swan document saying I think the startup world is going to be doomed actually, And I think I hope I don't have to eat my words, but in next 12 months they're gonna come back and say the same thing again. We had huge big investors, the ones coming out today, saying that when we used to go to them and say this is the path to profitability, they're all the time they were like, we've not asked for this. Show me the growth to growth actually. How can you grow 2x? How can you grow 3x? And I think we are going through that winter. We are over, emphasizing the fact that this is it is the end of the world. It is the end of the world. But I think what we are not lagging is we're actually shutting down a lot of innovation, a lot of disruption that we are doing. Paytm, food delivery. I think today all of us, I don't think any one of us actually has a restaurant's number in our phones. 5 years back, all of us used to have like 50 restaurants, call them, send the driver, ask that guy to, I think Zomato, Swiggy, between two of them, like spend $5 billion to just create that new market. Quick commerce is where it is today. Uber, Ola did that in India. I think what we are doing is, this conventional thought process of profitable companies who've been there for 50 years, cutting down the pace of innovation, will probably, move away. In 6 to 12 months, you will see new capital coming in, getting allocated to these. And the only good thing is actually it's just realizing us the importance of also profitability. So I think that is where it is helping us just like fasten up the pace of profitability.
This brings me to a question. Namit very well articulated to Kedar's response. I think the exercise that we're doing with the CFO board is also to put these thoughts together, assimilate it, and then put out a note or a paper which can can share what needs to be done now. But before that, I think the question which arises from all these discussions is, should the new age companies be judged differently from the legacy companies? Are we imposing a set of metrics on them which are not relevant? And as you say, they are perhaps killing innovation. I think that's the question which I would like to pose to all of you, and perhaps take, that could also form the basis of our outcome.
I think that debate's always been going on, right? The fact is that, and the one perspective of that is that if you go on and tap public markets, then why should you be measured differently, right? Why should
because SEBI has also come up with the new rules, right?
Yeah. And that's a counter to it, right? The regulators, the stock exchanges also realize this, that these models are different. So should there be a different set of rules to govern these companies and how they measure themselves? But I don't think there's an answer today, honestly. I mean, globally, if you look at in the US, they've lost more capital or market cap far more than what we have in our markets. There is no different threshold, right? I mean, you actually get an easier entry into the market if you're a startup or a fast-growing company. So it's kind of flip to the other way, right? You get access far quicker, but once you're there, I think the standards are very similar, very, very similar.
I would just say that for that, I think there has to be a communication from these companies as to how they want to be measured, how they want to be measured, and then a consensus can come out of that. Because one thing which could be there is, if I hear Amit and others, is if there is a path which says, okay, measure yourselves in this way, that we're creating this market or this change, and we're going to invest that much over the next 3 years or whatever. So then that is a given path that you can measure matrices there. But then it has to come out as to how do you want to be measured.
Just one point, sorry, here, just to add to this, because this is very important, because you're talking about legacy companies. What we also forget is that some of the legacy companies also took a long time. I mean, it's just that now with social media, with the quantum of money, etc., we figure it out. I was with Metro Cash and Carry. It took us 14 years to break EBITDA even. Nobody worried about that point. And it's EBITDA for positive for quite some years. Amazon, let me take legacy companies.
Yeah. So I do have to come to you with DMart.
I'll come to DMart also. So then, for example, my boss was Rajiv Bakshi in Metro Cash and Carry. He was the CEO MD of Cadbury's. He used to tell me Cadbury's took 25 years in India to start making profits. I've heard similar stories about levers. I don't know what the actual story is, because I haven't got anybody to say. Or like we forget, because they are older companies, we don't realize it. But in India, they took time, and it takes time. A lot of things are there. But the path is longer for us here, so that is the one. So I don't think it is the fact that the new ones are the ones making loss earlier, nahi banta tha. But the quantum involved, the communication involved, that has changed one perspective. But I think in the long term, I don't think there should be different metrics for judging new age companies or others. If I don't make money, I don't deserve to exist. I mean, that is, I don't think there's any debate at all. It might take some time, etc. But if I'm not generating value, what is the reason for my existence? I don't think it should be changed. It should be clear, money,
I
cash.
just want to add to your point here. Should I?
Please go ahead.
I just wanted to add to your point, because coming from a conventional sector, an airport business. Delhi airport is still not profitable, but it has a valuation. It has a valuation, and that valuation is based on a certain path to profitability. The path for profitability has been clearly articulated and has been clearly demonstrated to the investors, including the public investors. And the valuation is reflected of that path to profitability. Now, if you look at the new age companies, I think the issue is not that there should be a different metrics or different, or the business model is completely different. In fact, I think that because of the technology as an enabler, the capability of these companies to turn profitable is much, much more robust and strong. I think the issue is the mismatch between the path to profitability and the valuation today. I mean, you raised the point about Cadbury taking a long time to become profitable. Let's go back and find out that what was the valuation of Cadbury India at that point of time compared to what it is today, or what was the valuation of Hindustan Weaver when it was making losses at that point of time versus what it is today. So I think the issue is the mismatch between the valuation and the path to profitability. And I think in a publicly listed, let's say a new age company, these are the questions which are being asked of the founders and the management. And I mean, these are very capable people. It's not that, they are not able to address this. They are very capable people. But first is, you cannot very well tell that, look, I'll turn profitable after 5 years to a public investor. I mean, that will be suicidal today. If you go to a public investor today and say that 5 years later, I'm going to become profitable, I mean, he's going to dump your stock. So I think that is a clear issue. The issue is not about the capability, not about the ability of that business. It's a fantastic business and it is real also in all possible ways. But I think it is the mismatch between the valuation and the kind of the fundamentals at this point of time.
I just wanted to add to his point, even within Microsoft, right? If you take individual lines of businesses like Xbox, it took us 10 years for us to turn around and make it profitable. Same thing, with our own search business, right? It does take that time, like, but it's also to your point, like communicating, are we actually, making progress on the metrics through which we measure those individual business units, the KPIs, is it going in the right direction or not as well. And also the appetite for us to, like, how far do we cross subsidize, that becomes super important.
I think you'll also have to really take this debate a little ahead and talk about a higher purpose. We talk about innovation, we talk about new age, where are we going to be, the new entrepreneurship that is going to come, how is it going to come, the entire ecosystem of venture capital that we started. There has to be money which has to be available for ideas. So unless these ideas and money matches with some execution capability, that's how value will be created. Of course, there would be some mismatches between valuation, which went to some crazy limits. So that point remains. But probably there should be definitely different set of matrices, different set of number that will have to be evaluated. Let's leave alone the valuation debate today. But there is absolutely a need to identify and fund the innovations, fund the ideas, and let them bloom. Of course, let them bloom. It might take time, whatever time it takes, but it is extremely necessary to really look at that time, and from that angle itself.
I perhaps, Anilji, maybe I request you to share your views, because you are also, you've seen the old and the new together.
Yeah, that's why I'm quiet. Yeah, good afternoon. My name is Anil Parashar. I'm part of Interglobe, and as you know, we fly Indigo Airline, and we are also into hospitality, IT, and a few other businesses. So a little bit of both, but largely I would call it legacy, because now we have crossed that 15-year mark. So we have to be branded legacy.
There's a good question. At what point you stop being a startup?
You started.
When you start. Of course, I come from a fold of completely traditional founders who have never understood how you can have a valuation when you make loss. So that's a mindset we are in today. So, that's why I'm absolutely quiet, because I'm sitting with some honchos who are changing the game model. So ultimately, it boils down to, one thing where I feel there is a differences between a growth and a scalability. That's something I always kind of struggle. We always call growth scalability in the same. Is my business scalable? And I may not be growing at the pace I should be growing for multiple reasons: cash, profitability, whatever strategy. I'm not getting into that. Second is, like Siddharth correctly said, where do you draw that attention that I'm going to turn around, and am I turning around? That I think are the 2-3 big questions that people are starting to now question, what am I doing? And like Subrata said, what's the purpose of if you have somebody who wants a growth story, who's obsessed with that, he wants to burn money, like my boss says, why would I throw good money behind, bad? That's like I'll recall a little story. A few years back, Pranoy, he's my neighbor also, he called me and said, I have a great idea. And I'm a bit of a slow, and in my mind level, so I don't understand much of it. So he said, I have 60 million viewers, Indigo has 40 million, we'll combine together, we will start an online, we make my trips and everybody out of business. I have the media, you have the aviation, we will start this. So let's have 100 million market and start. So I came and told my boss, he said, listen, you better go back to your work. First you tell me how you're going to show me that profitability. I understand the money piece. We'll keep throwing the money. We'll have 100 million. We'll be watching every day on that TV screen. And the moment I drop 1 paisa, they'll move to make my trip. So you just show me that. So it's just kind of giving this analogy, little story to make my point. That where do you draw that number? Where does it make sense? And if somebody really wants to burn money and say, I want to be the king of the market, and at some stage I'll dominate, great. Uber and Elon Musk, it's a great strategy because he's ready to write a check and say, I'll burn $10 billion. I'll take a punt and I'll turn the country around, turn the model. Great. But can everybody do it? No. What it has ended up being is a fashionable word. That startup to hona hi hai. Agar nahi startup hai, to you're somewhere, you're like out of time. So I think that is where you have to take a step forward and a step back and look at yourself and your organization and your mindset. I can give you a guarantee, even if our company was $100 billion company and we were to burn $1 million, some of us will be thrown out of job because our founders don't understand that word. It is just as good or bad, but that's the way it is. So that mindset is important. And I think we need to respect people who are changing the paradigm, or changing the thought process, as we have heard. Hats off to them. Some of these stories have come out. But how many failures are there to make these few successes? I think that is something which is not everybody's mindset. So we have to respect both sides and the mindset. It's good. But like you said, end of the day, where is the money? And I keep kind of telling everybody whenever I give examples, I give example of Warren Buffett. And he's the ultimate for many of us in terms of what a businessman should be, both in terms of his lifestyle as well as in terms of business. And 3 years back, and most of his shareholder meeting minutes are online, available on Google. So he was sitting on $100+ billion. I think it was 106, but I'm not sure. And the shareholder asked him, you're such a slow coach, you're such a slow person, you don't utilize money, that startup has become Amazon this, and you're sitting on the money. So he said, when I get the right opportunity, I will invest. And I will look at this from this aspect. A year later, he was sitting on 110 or 112 billion. And they said, I've still not invested because I haven't got a good opportunity. It's just that it's me. So, here is somebody who's saying, I will invest. And then he goes and invests in some aviation stocks, which I thought was like surprise. But that's how the man is thinking, and respect him for whatever decision he's taking in line with his team and whatever. So that's, I think, few things from my side. very important mindset, how you view life, how you view business. And if you are good, throw money and turn the model, great. The only important element is where we come into the public domain. Where should you be at the public? Should you be taking public into picture, or kind of, I would use the word outsmarting, but public, gullible public? Is I think, where somebody needs to be careful that, the success stories, they don't understand. Sab bol raha hai, sab bol raha hai, hum bhi dalega. So that is where I think SEBI needs also to be getting. Thank you.
Thank you, sir. Any of our board members online, would they like to come in at this point?
Yeah, no, thanks, Pranjal.
Rajiv,
Yeah, hi.
I must say you're looking very celestial today.
I am definitely in a different stratosphere, being in the startup ecology for the past over 2.5 years.
Rajiv, please introduce yourself too as well. Thank you.
Okay. No, thank you. No, I think most of the CFO board members know me, but I think this team, which is presenting, doesn't know me much. I should have been there, but some exigency came up, so I could not. So apologies for it. Obviously, have been in the corporate world till about March of 2020. Was my last assignment was the India Hub whole-time director for Boston Scientific, leading finance, operation, distribution, IT, new business development for about 6 countries. So there was about 8.5 years. And prior to that, I worked across sectors. Prior to that was with the CFO for Prudential Financial in India for the life insurance and the AMC space. Prior to that, with I keep forgetting Dell, worked closely with Michael Dell to build all the setups in India as we see today. And prior to that was with Max Healthcare. What you see in the NCR region did the entire funding through Warburg Pincus, IFC, and what Max Healthcare, which everybody sees, I think has been a great story now. And prior to that, with Gillette, Ricoh Japan, Owens, and
that's a long list. Yeah, because we have 10 minutes to go. So sorry.
Yeah. No, absolutely. So I just didn't want to bore you over with these perspectives. These are all history. Now I'm a part of the young age journey of the startups, and having invested in over 70 plus startups, I think this is the most exciting phase. But I agree with what I think has been articulated with Anil Bhai, Siddharth, Sugata, and the others in terms of these pieces. I would only say that for us, as now with the COO or advisory board member of JPI in UK, where out of 5,000 startups which came to us last year, we funded only 40. And mind you, the key pieces were the business model. Obviously, founders, ability to build a rock solid framework of the business, which is ultimately going to be profitable. Obviously, we can fund. Like Blue Smart today is looking at the market to raise $250 million. Obviously, we are supporting them and to build it. But what I'm trying to give you a context is when it was raising about $10 million, it was difficult. Now coming to the market today, 250 is not difficult because it has got a rock solid model. It is giving the perspective of profitability. What is important besides what the others have said, I will not repeat. I think echoing the point that there has to be a definite timeline for profitability. Cash conversion cycle is extremely, extremely important. And that is something which one can look at it for maybe 18 months to 24 months, but you can't keep funding and keep building up losses. The other is the moat. Do you have a rock solid moat in the business? If you have a moat in the business where you have a runway for at least 3 to 5 years, I think fantastic, you will find takers for it. Then the other piece, which is equally important, is the governance framework. We will always fund business which are built frugally, which have a kind of a timeline within which they will build it into a solid cash flow framework. The other piece is also extremely important, the corporate governance mechanisms. I think frugality, having a moat, having the right corporate governance, having the model which is sustainable, scalable, has a huge market, even if a disruption is there. the innovation has to be meaningful. You cannot have innovation which you cannot make money out of. Obviously, the core ethics and the compatibility of the core founding team, extremely important. If they are not compatible, if they are not aligned, we will have fights in the boardrooms, we will have fights in the marketplace, it will not work. And the last piece, what we also look at in terms of all these businesses, what we are funding or going to fund, are the pieces that these folks have a kind of a vision to be among the top 1, 2, 3 in their markets, whatever space they are wanting to operate in. And I think if those are the key pieces are coming about, obviously I can keep talking for next 2 hours on the startup ecology, but I think those are the important factors which are critical for any venture to really take off ultimately from a pre-seed, seed to an IPO stage. And if it is sustaining all these, it will keep having valuation. You can't just take all the money on the table. You have to keep enough money for every participant in terms of investor who's coming in. And if they don't, you are not going to, you may be able to raise it once, twice, but I think after the market is not going to forgive you. So I think that is extremely important for any venture to really take off. And India, with all due respect, with China going down in its own space, I think if we get the right businesses, get the right promoters, India still has close to about between 15 to 70% of the youngsters who want to get into the entrepreneur space, which is much higher than America, which is much higher than China. So opportunity is huge. And I think as I see, startup ecology could make us into a $10 trillion economy in next 10 to 15 years.
Thank you, Rajiv. Thanks so much. So we have to end the session here. As you said, we can all continue for longer. It's a very exciting debate. And every few months, I think we'd like to come back to this debate around the unicorn space, because there's learnings for both unicorns and I should say the 2-year companies and the 20-year companies, right? So I think that's a new phrase, thanks to Venkatesh, we have discovered. I'll request Karan and Venkatesh to give a quick closing comment and then request Abhay to summarize.
And we should come back, Pranjal, when the environment is more positive. I think so, it's totally biased to against us right now.
No, but actually, Abhay, that's the reason we decided to have this conversation, because it was that suddenly when the fund stopped, all these new debates began. And we'd like to come back with your thoughts and views on, let's say, the idea is that we've discussed is to have a series of such conversations and outcomes, and your views and thoughts on that, on what we could address, because it's a changing dynamic. Every 3 months, every quarter, we look at some new element and dimension emerging, which didn't exist or perhaps was dormant, but now suddenly is front and center. So I'll request all of you to share your feedback and thoughts on that. And Sakshi, you can put up an email address for everybody's reference. So may I request Karan and Venkatesh for a quick closing comment from what you've heard, and then Abhay will summarize.
I think it was great interaction. I think for me, the takeaways are, honestly, I don't see a difference. I don't see a dichotomy between profit and growth. I think it's both go together. Again, to your point, some get amplified at some point. I think we live in a world of instant gratification, like you said, so everything has to be real time. But I think to me, I honestly believe, and that's the reason I've also invested in a bunch of startups, that there is real value that we are all creating, and businesses that are that we can consume from. I think to me that's the best validation of how real a business model is. So
I think it's important to continue to have these discussions. They also raise awareness, especially about the governance aspect and the communication aspect. So it's quite important. Having said that, there is a what I would say understanding, improvement amongst the public about what we contribute, etc. See, I'm different vintage, slightly older vintage compared to Abhay, but I had already had 20 years in pure multinationals. Then moving here, I am finding it really exciting from a job satisfaction point of view. So from a professional aspect also, it is very different. I demolished my average tenure also. Having
so, I know we're out of time, but I did want to ask both of you, one person, stay where you are today, given everything else that we heard today.
Sorry,
one personal attribute that's helping you, stay afloat today, that you believe is important.
I think for me, it has been, personally speaking, has been segregation of work and personal life. I don't carry that because the number of hours is quite high, and like I had an early start today also. That's what is helping me. But and the joy of trying to create something. We're still not sure whether how long it will last, etc. But at the point I'm enjoying. So that's the thing. I think more important to continue to have that efforts.
I think one attribute you need to survive is just, I think, curiosity, right? If you want to do the same thing day in, day out, it's not the place for you. But if you want to learn, you want to develop, and I think paint on a wider canvas. That's one attribute.
How would you summarize our discussion today and the key points, I think, which we can take forward for our paper?
So I think I made 4 or 5 key points. I think the first one is a realization that times have changed. That investors have moved from being cheerleaders and solely focused on growth to focusing on what it takes to build a real business. And I think that's a good change. I think all of us agree that's a good change, and it's much needed to cut the froth out of the system. I think the main question we discussed is what constitutes a real business. There are people who worked here on hardcore asset-heavy business model with long gestation periods. There are people who have built businesses just on services. But in all cases, there is a real consumer need which is being fulfilled, right? And we briefly alluded to the change in consumer habits we've seen, be it food delivery, mobility, services, the way you make payments. And the core is whether it's a real business model. We also alluded to the fact that, businesses have been built less publicly in the past, right? Many companies have funded, long maturity periods, some well-known legacy names. They've been built less publicly with less social media scrutiny. And that's a big change. Is it fair to judge people building absolutely new models by the same metrics? I think the jury's still out of that one. I'm not sure. I'm convinced that that these are the right metrics to judge a new model. But I think the real realization I had was the more things change, the more things remain the same. Right? The point is everyone needs to make money. There's no doubt in the fact that a real business makes money, generates return on capital. What's important is everyone's focused on that, on building the right governance. I think one aspect we covered briefly, but to me it's very important, is clear communication, right? I think Prabhupada referred to it in between. How do you communicate your story to investors? How do you make sure they understand? And how do you make sure that every other aspect of your business, which is good governance, long-term thinking, is understood? That's my answer. Yeah.
Thank you. Thanks so much, Abhay, Venkatesh, and Karan for leading this discussion. And we'll appreciate all your thoughts and views. And to all of you for being here in person, and everybody who joined us online. And finally, once again, Abhay, for hosting us. Thank you so much. And we look forward to continuing these conversations over the next few weeks. Thank you.
Thank you. Thank you.
We'll take a short photograph, small photograph
Thank you.
for everybody.